On. Hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter like we normally do, go through social media, see what people are sharing. I'm going to interject my financial opinions, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in here. Let's take a look and see what people are sharing. If you want to follow me at finding_finance, and if you want to join our community, finding-value.com. That's where I dive deeper into these topics, into these individual sectors, individual companies, dive into entry points using technical analysis, using ratios, in the combination of all of the above. We do have a discount going on, Mayday, Mayday, one word. If you want to try it out and or get a discount switching to the yearly membership. So let's start with Peekaboo on Coca Cola. We do have kind of that three hump consolidation. One, two, the third hump sometimes goes all the way down, and sometimes it doesn't. It breaks out. The third hump's kind of a mystery hump, is what I'll call it. And we don't know if it's going to do a full retrace back to where it originally started, or if it just breaks right on out. I've seen it in just about every single case. I've seen them go straight out and break. I've seen them come a little bit like this, down here, all over the place on that third hump. So Coca-Cola is breaking out. Exxon Mobil about to hit the gas. And here's another one. First hump, second hump. You could consider this one the third here, and that we're ready to break to the upside. So that's Exxon Mobil. And what do we use Exxon Mobil for? I mean, it's an oil company, but we can use it as one of our leading indicators. The big diversified mining companies generally lead the small guys. So we can look at the big leaders, we can look at the bigger companies, and we can see, you know what, this is starting to break out. We should probably be looking for a breakout on the smaller names. It'll next be most likely the mid cap type companies, and then eventually get to the small caps. So this could be breaking out here. One to watch: Exxon Mobil. You can also watch Chevron and ConocoPhillips and those types. Do you think 2 million is enough to retire on? I think that highly depends on the person, what their age is, and how much they spend. Is $2 million enough to retire on when you're 21 years old? Probably not. Is $2 million enough to retire on when you're 65, 70 years old and your expenses are very low? Yeah, probably. It's probably just fine. So the answer is going to be dependent on the person, how much they spend, and what they own. If you own your house, great, you don't have that expense. And if you're living by yourself, yeah, 2 million bucks is a lot of money. If you have a family of five to support and you're only 20, 29, 30 years old, your expenses are going to be a lot higher. And even though you might be able to get some really good dividends and knock out a pretty good dividend, depending on where you're at, you're also going to be subject to a lot of market fluctuations, and your dividends may get cut with time depending on what sectors you choose. So I would say highly depends on how old you are, where you are in life, and what your expenses are. Because this remember, that's just $2 million. It doesn't say what your assets are. If you own a house, is that part of that $2 million that you're counting on? Or is it 2 million cash? You own your house, and I mean, I think you'd be all right for a lot of situations as long as you're on the older side. It says teaching my sister how to invest. So far, I've told her to make sure she's enrolled with her employer 401k plan, open a Fidelity taxable account, invest up to the employer match into your 401k plan, purchase a target date or balanced index fund, put extra investment money into a Fidelity taxable account, purchase an S&P 500 international index fund, use extra money after investing to pay off her mortgage early. What else would you recommend to her? Well, I think it depends on her situation and how much money she makes. If she makes a lot of money, or if she makes kind of like the average, I don't see any Roth IRA contributions. in this mix here. I think adding money, after tax money, into investment accounts, depending on how much money you make, is a smart move when you're young. That's probably where I would focus a lot of the money. If you aren't making a lot of money and your taxes are pretty low, your 401k, you still get an employer match, but I would probably do that in a Roth 401k, not a pre-tax 401k. Then I would put more money into a Roth IRA, which is all tax-free generation when you yank it out at the end. And that highly depends on how much money you make today, because if you don't make a lot, let's say you make $70,000, and I know that's kind of a lot, but it's not a lot, your taxes probably aren't too bad. And I would say try to get a bunch of money in after-tax accounts where it grows tax-free. So that's where I would focus my efforts is try to get tax-free accounts. And I don't see anything here talking about tax-free accounts. Now, it depends what her mortgage is too. I am not paying off my mortgage early. I am letting inflation eat through it. My mortgage rate is 2.75%, and that is below the inflation rate. So I can basically take money, put it into bonds that pay higher than 2.75%. And then I can use the payments from the bonds to pay off my mortgage. So I don't know what the situation is here. I don't know what the interest rate this person is paying, but you can literally put money into bonds and net the difference between maybe 5 point something percent versus if it's in my case 2.75%, I can net that delta with pretty low risk. Or you can just say, screw it, I'm going to go get some big dividends in some oil companies or something like that. Those are my opinions there. Something's up with Bitcoin versus Cameco. So Cameco is a uranium company, and I got a lot of uranium viewers. Bitcoin does look like it is starting to roll over. This would also be a function of not sector versus sector, but actually a changing market condition. And I don't think people think like this. The market condition that Bitcoin does real well under, this started at the beginning of a technology boom. So the tech stocks, they do very well at the bottom of a recovery phase of real estate. Low inflation, low interest rates. And you can see that we are rolling over. I think what is occurring is the market conditions are going to weigh on Bitcoin, and it's going to be hurricane force winds behind uranium and other commodities and precious metals. And when you price these two against each other, that's when we're seeing the rollover. We're seeing the changing market conditions through this ratio, which is basically Bitcoin, which is like a max leveraged NASDAQ technology product, is what we'll call it, and Cameco, which is a product of uranium and commodities. So commodities are about to hit it here, in my opinion. And I think technology could definitely roll over in relationship to commodities. So what he says, in his opinion, is up until the arc touch point of number 3, the longest it had taken Bitcoin to reach new highs versus CCJ was 2 years. BTC has currently gone nowhere versus CCJ in 6.5 years. Is BTC losing long-term momentum? Well, obviously it's losing momentum, yes. But I also think Camco is starting to it's starting to gain momentum. Coming out of North Star again, I like these charts that he's got here. Gold versus Bitcoin. This is precious metals, and again, we're looking at two asset classes that perform differently under different market conditions. So I think that the market condition is changing. And the one thing you want to look at here is look at the red arrow. Big downward move with BTC ripping it on gold. But then you can see we're flattening out, the rate of change is flattening out. And now we're basically bottoming. And we've broken out of the resistance line. And this is what a bottom looks like. It's what it feels like in a ratio. So I think we're going to have a big move up where gold is going to outperform Bitcoin. And people are going to say that's not possible. They aren't accounting for the change in the market conditions. Money's going to rotate differently when humans are subjected to different conditions. And what I mean by that is when you subject humans to high inflation and higher interest rates, money rotates differently in the system. It doesn't go into bonds, it sells bonds for a period of time. It doesn't go into stocks or technology stocks if rates remain high or go higher because the discount rate that they use for calculating high growth stocks values those stocks lower in a higher interest rate environment. And I think it's going to take a lot of time for this bottom to work its way out because we are coming from a declining interest rate environment that was 40 years in length. And that just doesn't happen overnight. You have to change the entire herd's paradigm and what they are used to for the past 40 years. That is going to take some time, guys. But it's going to be oh so glorious when they do start to convert over to the commodity and precious metals group. Here's Uranium Miners, another one from North Star, and this is Uranium Miners URA beating the S&P 500 since 2020, and that was the bottom of the commodity to stock ratio. So URA is more or less a derivative of the commodity index for the most part. And the conditions are changing, and we are starting to work our way on up where URA is starting to beat the S&P 500, and it has been since 2020. Is there a bear case for gold and silver right now? Opening up the comment section for discussion. The only bear case that I can think of is that we actually get a recession and everything collapses, and then you would still get a decline in paper dollars for gold and silver. Unfortunately, though, that could also be a bull case for gold because everything else is going to fall faster than gold outside of maybe the dollar. So you could argue that what I just described there is also a bull case for gold, not necessarily a bear case, because as an investor, you want relative strength. So gold could fall 10%, but if the stock market falls 80% in a recession or some blowout recession, you still win in gold because it went down a lot less than all the other assets. So you actually went up in purchasing power against other assets, but you went down in dollar value for a short period of time. And that's actually preferable because then you can rotate your assets into another asset class, get more of that asset, and pay zero in taxes. You actually record a loss. That's actually favorable. Drug money. Ooh. What are some common mistakes to avoid when investing, especially for beginners? Here's a couple of mistakes, guys. Listening to people on YouTube that claim to be experts and then taking those words at face value all the time. What I think you need to do is you need to find yourself a mentor and learn how to do this. Once you learn how to do it, then you can cut through the crap. There is a lot of crap out there on YouTube, on Twitter, and I think it mainly resides around those people trying to get views. Because what they sell as a product to humans is they're going to tap certain buttons of yours. They're going to tap the fear button. They're going to get more views with catchy titles with a lot of fear in it. So what a lot of YouTube people end up being are fear mongers because that's what they get rewarded to be. It's not their fault necessarily, but that's something that a lot of YouTube channels kind of turn into is fear, 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 recession, recession, recession. And more than likely people are going to click that link because of the internal fears that humans have and the psychology behind it and the curiousness that is stronger on a pullback than it is on a successful win. So I would be really careful on where you're learning all of your information and what they are presenting. What I have found is that They've got a lot of the data, but they don't know how the data is interconnected between each other. And that's where it gets difficult. That's where I think I shine. But that's my opinions on a lot of the YouTubers. A key indicator of economic prosperity is money velocity. Higher velocity is observed when trade picks up. When trade picks up, more real wealth is created. For more than 2 decades, the velocity of money in the US economy has been trending towards zero, and this is not healthy. Well, I don't know if that's 100% right. So, yes, you can get trade picking up, but the velocity of money, what that is basically talking about is it's the gross domestic product in the system given how much money you have in the system. So your denominator is basically how much money is in the system. And then on the top portion is how many transactions with that money occurred. That's really what velocity is. Now, here's the tough part. You could have a certain amount of money in the system remain constant, churning out the same amount of gross domestic product in terms of transactions. But if they print money and do a bunch of QE and put it on a balance sheet and put all this money into a bank that just sits in banks on balance sheets, I think the velocity of money goes down when that occurs. So it's difficult to gauge what's going on here with all the quantitative easing and stuff that they've done because they might be creating a buttload of money and keeping it out of the system. It's not reaching into the system as it would during different market conditions like bank lending and stuff like that. So I don't know how valuable money velocity necessarily is in a system where they're keeping all this money out of the system to some degree. And it might not get calculated in velocity. Energy headline news says, according to Gas Buddy data, weekly, Sunday to Saturday, U.S. gasoline demand for the week ending 5/11 rose 1.1% from a week ago and was 1.5% above the 4-week moving average. We model U.S. gasoline demand at about almost 9 million barrels per day. Okay, so gasoline demand is going up. I thought we were in a recession, guys. I thought that would go down, right? Assuming we see uranium price of $200 a pound within 1 to 2 years, which company do you think will gain most in percent from here? So his bets are on all of those companies there, but additions are always possibility. Looking for high leverage, low dilution, good cash flow, or undervalued assets. And he put all these companies are not really fit that description necessarily. But here's my guess. If we're in the thick of a bull market of uranium and you're looking for what you think is going to be the most percent gain from here, it's probably going to be a junior company somewhere. Which one? Flip the coin, guys. I've got my favorites, my favorite juniors, and they are all based off of the fractals and the technicals that they are basically showing me. There's nothing that you can really do to value some of these explorers. And, some of them do have, they've hit something. We don't know how much it is, but they've hit something. I think those are good bets. A company that's an explorer that has hit something, they just haven't basically defined the deposit yet. So I think there's a couple out there that have done that. I'm not going to give you the names, that's for the members, but um, yeah, there's a handful that I think could do really well. And my approach isn't to guess which one is the best. My approach is to take a basket of those that possess traits to be the best and get a little bit of money in all of them. That's kind of my approach. And I do think if we are going to hit a uranium bull market here, which I think we're in, then some of these juniors are going to take off when no one's looking. And then people are going to be FOMOing in later. That's how it always works. Global manganese markets have been hit by an instant 10% supply shock as the Gemco mine has been damaged by a cyclone and won't come back online before March of 2025. Wow, that's a long time. Says this is a significant and prices have started to respond. What's the trade here? This is the Gemco mine in Australia that got hit by a cyclone, I guess. We've got manganese ore production. It's this 15%-ish, 10%-ish. And average content of manganese alloy per ton of steel is 7 kilograms of manganese content per ton of steel. Manganese makes steel harder, more elastic, and wear resistant. Wow. So there we got that going on. And here we can hit 202 here real quick. Highlighted by Respecter. So Jupiter Mines, a key manganese producer with operations in South Africa, is one that he is bringing. Let's assume, and I'm not going to go through all the stuff there, but that was his pick of 2 was Jupiter Mines, if you want to do research into it. On the topic of rents, talking about renting, 80% of renewal in nature. Here's the latest from John Burns on what is going on with renewals. Holding strong and probably going higher on easier comparisons end of year 2025. So renewal rent growth reported by single family rental REITs range from +5 to +8% in major markets. We've got here apartment renewal rent growth is sticky at 5%. So rents are increasing at that rate. This is the housing market they are trying to argue is in balance. I mean, just open your eyes. You could only believe this if you were 65 to 70 years old and had not bought a home since 1985. So basically, homeowner vacancy rates are just plunging to crisis level. They haven't been this low basically since ever. So we're at the lowest time going back to 1955-60, wherever this begins, to where we are today. We are in a crisis level in terms of vacancy rate in the United States. But we don't have a problem, right? We're in a bubble, right? But we can't be because we have no actual open homes. Next, we've got vacancy rates versus rent inflation from 56 to 2023. Again, rental vacancies really low in the 70s and 80s, and we are also very low where we are at today in terms of rental vacancy rates. Rent inflation is obviously way up there, along with what occurred in the 70s. That's that big bulging demographic coming through, the baby boomers, and 30, 40 years later, we've got our other demographic coming through, where they're coming into home buying years and also moving out. And some of that has been delayed to some extent, a little bit longer. They've been living at home a little bit longer, is what I'll say. And then we've got the house price index continuing to move up. I know there's a lot of premature bubble populators out there, but I think it's going to remain resilient until we get actual vacancies, like an actual bubble, actual inventory, and all those other things. So that's what I've got there, and that's where I'll end it. So give me a thumb up for the content, subscribe to the channel. Uh, that's all I've got. That's what I'll say. Trying to think of other stuff to say, but I don't really have much. So we'll end it there, and we'll catch you next time. This is Finding Value.